Hello everyone. In the continuation of the last internal factors of affecting capital structure, today we shall see the external factors affecting the capital structure from 8th chapter, that is financial management. The first external factor which affects the capital structure, the decision for capital structure is condition of boom, depression in capital market. There are two main conditions of market, that is boom condition and recession or depression condition. These conditions affect the capital structure, especially when company is planning to raise additional capital. Depending upon the market condition, the investors may be more careful in their dealings. During depression period in the market, business is slow and investors also hesitate to take risk. So, at this time, it is advisable to issue borrowed fund securities as these are less risky and ensure fixed repayment and regular payment of interest. But if there is boom period, business is flourishing and investors also take risk and prefer to invest in equity shares to earn more in the form of dividend. The second external factor, that is present rate of interest in capital market. The prevailing rate of interest plays vital role in determining capital structure. If rate of interest are higher, firms will delay debt financing. On the other hand, if prevailing interest rates are lower, firm will opt debt financing. The third is cost of capital expenditure of issuing securities. Now, these costs are the costs involved in the issue of shares or debentures. These costs include the cost of advertisement, underwriting commission, brokerage, stationery, and many other expenses. Normally, the cost of debt is less than cost of issuing shares. Therefore, the company can be attracted towards the loan funds. In case of retained profit, no such issue expenses need to be incurred. The fourth is legal restrictions. The statutory restrictions prescribed by the government and various other statutes are required to be taken into consideration before the capital structure is planned by the company. The company has to decide the actual structure within overall framework prescribed by the government or rules of SEBI, that is Securities and Exchange Board of India, and RBI, that is Reserve Bank of India, as well as provisions of Companies Act. Thus, issue of shares and debentures have to be done within the SEBI guidelines and for taking loans. Companies have to follow the regulations of monetary policies as well. If SEBI guidelines are easy, then companies may prefer issue of securities for additional capital, whereas if monetary policies are more flexible, then they may go for more of loans. So this was the legal restrictions. This is one of the factors which has to be considered while taking the decision for capital structure. The fifth one is taxation policy. Under the provision of the Income Tax Act, interest paid against debt is tax deductible expenditure, whereas dividend paid on equity and preference share capital are not considered as tax deductible expenditure for the company, causing the high cost of equity funds. Hence, issue of debt capital is more preferable than issue of share capital as it reduces a firm's tax liabilities. The sixth one is institutional investors. If financial institution prescribes high terms of lending, then management has to move to other source of financing. If financial institutions prescribe easy terms of lending, it would be advantageous to obtain funds at cheaper rate. Thus, the financial manager must also seek the opinion of prospective lenders and investors like insurance company, banks, financial institutions of state and central government, etc. because as per established rules and conditions, they have to provide funds to the company. From it, the company can know in what type of securities they want to invest, and accordingly financial manager can take decision to include these securities in the capital structure. The last factor affecting capital structure is foreign institutional investors. Foreign institutional investors, that is the foreign investor institution, is such an institution which is established and registered out of India and whose objective is to invest in prescribed securities in India in primary and secondary markets. But they have to make registration with SEBI, and they are permitted to purchase shares and debentures of Indian company then only. Thank you.